when you enter a trade, usually you like to plan targets, usually you like to plan profits, usually you like to plan rewards. But if you have seen any professional who has been trading for a longer period of time, they will always ask you to plan your risk. That means if you are ready to lose up to 3% in a single investment, then you are a moderate appetite risk investor. If you have a low risk capacity, then you would be looking for a risk less than or 1% or less than 1%. If you are a high risk taker, you would be looking for a risk of around 5 to 10%. That's how they plan their risk. Hey everyone, I welcome you all in Hold with Priyank, and today we are going to discuss another good concept of trading which you always need is risk management. And it will be about cryptocurrencies, forex markets, where you trade different currencies, commodities and stocks. The same kind of risk management you can use in all of those markets. Why do we need it? And how should we actually work to plan our money better for a good risk management? All these topics will be covered in this video. So go ahead and read this disclaimer, and I'll see you after that with this board, and we'll explain risk management in trading. Here we go. So what is risk? That's the first question. See, what happens is when we enter into trading or investing, any of this, okay, because many of you would be investing in cryptocurrencies or stocks, many of you would be trading in cryptos and stocks or forex markets. So in trading or investing, the first thing we need to understand is risk. Why? Because most of us come for profit in this market. Whenever we first come to know that, hey, I'm going to start the trading, or any of your friends recommend you should start investing or trading and you can make such kind of money, these kind of commitments usually happens from the end of our friends. We start trading and actually we go ahead, start trading, and we end up doing losses, sometimes even big losses. And the biggest reason of all the beginners, all the newcomers in trading and investing is to face losses. The biggest reason is that because they never learn risk management, they never learn what is risk before starting trading or investing, and end up in the losses. And I will try to help today how you can learn this risk management very quickly, very easily, and start implementing the same concepts you were using in your trading and getting better results. So let's see how it works. So first we need to understand this risk. So it's as simple as that. When we ride a motorbike, okay, or when we drive a car, in both the scenarios you always have some kind of precautions, such as when you are riding a motorbike, you always use helmets, right? Even sometimes gloves, good shoes, and you always take care of kneecaps, etc., etc., so that if any mishappening happens in unfortunate scenario, you can be safer side, correct? Similarly, when you start a car, you usually like to buy a car with airbags. You like to tie on the seat belt before driving the car. Why? Because precaution. Even when you go for boating, you always take a life jacket, safety jacket, just in case of any unfortunate incident. You can actually swim using that life jacket, and that can be helpful for you. So all these things you plan, not to go and start, not to go and have an accident, or not to go or your boat will get a hole, definitely not for that, but it is a precaution. Similarly, risk management is something which is a precaution in trading, and this risk can be your seat belt, this can be your airbags, this can be your life jacket. All right, so that is why it is very important to learn. So what is risk? Risk is the precaution you take before entering into a trade. And what is that in terms of finance? It's simple as that. When you enter a trade, usually you like to plan targets, usually you like to plan profits, usually you like to plan rewards. But if you have seen any professional who has been trading for a longer period of time, they will always ask you to plan your risk, not your targets, profits, and rewards. First thing is to plan is risk. And you can see it in mutual funds, stocks, investment, SIPs, right? In all of those, when you open a demat account, the first thing when you start investing in mutual funds, they always ask you, what is your risk appetite? Have you seen it? Have you opened a demat account ever? If you have, You might have seen they would be asking you, there might be a spelling mistake in appetite. Manage that. So risk appetite, what kind of risk taker you are. You are a low risk taker, moderate, or high risk taker. Have you seen it? And if you have seen a moderate moderate risk appetite is usually known as 3%. That means if you are ready to lose up to 3% in a single investment, then you are a moderate appetite risk investor. If you have a low risk capacity, then you would be looking for a risk less than or 1% or less than 1%. If you are a high risk taker, you would be looking for a risk of around 5 to 10%. That's how they plan their risk. Similarly, when you start trading, you should start managing your risk, and you need to understand what is your risk. And this risk is actually I'm talking about in a single trade, not on your whole portfolio, but in a single trade. So what I'm trying to convey you with a simple example, I will explain you. So let's suppose if you have, let's suppose you have $10,000, all right? Or you have, similarly, I will give you a price like you have 50,000 rupees. Giving you in both the cases, if you are trading in dollars or if you're trading in rupees, okay? So if this is your initial investment, when you start trading, the first thing you need to know that if a trade goes against me, if it goes south, like I wanted it to go upside, but it starts dropping, it hits my stop loss. Even if you don't know what is the stop loss, then you need to learn a level where you will exit a trade if it does not favors you. Let's suppose you buy an XYZ stock, let's suppose at 1000 price, and you are planning it will go 1500, but it starts dropping and it reached to 800, all right? And you have decided if it reached to 800, I will cut my position, I will book my losses. That is your stop loss, all right? So if trade starts going south, or if it starts going towards your stop loss, how much you are going to lose in that position. So what would be your loss in that position? This is called as your risk, all right? This should be, with the standard, must be between 1% to 3%, depending on your experience and your expertise in trading. If you are very new, if you are a beginner, start taking risks such as 0.25%, 0.5%, 0.75%, or 1.0%. These kind of risks you must take in a single position. And if you are good with your trading, you know winning strategies, you have been trading for a couple of years, more than that, you can increase it up to 3%. You can keep it 1.5, 2, or 3%. That is totally okay. So what does it mean when you are using such kind of risk? So if any trade you take entry in, if it goes against you, you cannot lose more than this percentage. All right, I'll take the example now. So if you have $10,000 and you have set that in any case, I don't want to lose more than 2%. You have decided that I don't want to lose more than 2% in a single trade. That means your trade, if hit a stop loss, the maximum loss you can take is 2% of this amount, $10,000. That would be, I think, would be around $200. Correct? Similarly, if you have 50,000 rupees, it would be around 1,000 rupees. So in any trade, you are not ready to lose more than 1,000 rupees or more than 200 US dollars if you have this balance or if you have this balance. That is called your risk. So if you have $10,000 and you are ready to lose only $200 in a single trade, that means it will take 50 stop loss straight. Similarly, if you have 50,000 rupees and if you're ready to lose 1,000 rupees in a single trade, again it will take 50 stop loss. That means you will have to be at the wrong side for straight 50 times, which is quite hard to happen. Even if you start buying and selling on a toss of a coin, you will still win some of the trades, correct? So it will take at least 50 trades for you to go bankrupt with this kind of risk management. If you are taking 1% risk, it will take 100 trades. If you are taking 3%, it will take 33%. Sorry, it will take 33 trades straight stop loss for you to hit. You're getting my point? So that's what called is risk. So first, before entering a trade, always decide what is the maximum amount you can lose or you are ready to lose. All right. But now question comes is, when we enter into a trade, Priyank, when we enter into a trade, the stop loss would be different for every trade, correct? There might be a trade with 0.5% stop loss, and there might be a trade with 3% stop loss. There might be a trade with 15% stop loss. So how would I know that every time I will lose the same amount? How would I fix that I would not lose more than 1,000 rupees or more than 200 US dollars? How would I know? How can I fix this? This is practically seems impossible, but it is not. That's the key. And that's where risk management formula comes up of position size. Always remember, this particular formula can change your trading journey, and it can stop you losing all of your money in a single trade, or even in couple of trades, right? Look how it will work. So all you have to do, whenever you get a signal, you get an entry, you get a stop loss, you get a target. Whenever you have all these three and you want to take a trade, first use this formula. All right, so there are two kinds of formulas you can use. Position size can be decided by either by quantity you want to buy, or either by money you want to invest. You can choose any of the formula depending on the market. So if you are buying stocks, such as in Indian markets, their stocks cannot be bought in fractions. You can either buy a company's stock, one stock, two stock, three stocks. You cannot buy 2.5 stock, correct? So there you can use the quantity formula. And in all other markets, such as in crypto markets, such as in Forex markets, you can actually use the money, how much money you are going to invest in a single trade. So I will be telling you both the formulas. First, I will go with the quantity. So to decide how many quantity you want to buy, you need to use a very simple formula. It will currently, it might be taking your 10, 15, 20 minutes in this video, but it will take only couple of seconds when you start practicing it. Quantity, this would be whatever the risk you want to take, you need to write it down. So whatever the risk you want to take, you need to write it down, and stop loss below this. But remember, the risk must be in your currency. That means it's either in rupees or dollars you want to lose. And stop loss must be in points, not in percentage. Remember this, stop loss must be in points, not in percentage. So let's suppose you were ready to lose 1,000 rupees, correct? 1,000 rupees in INR. And let's suppose your stop loss was actually 50 points. How much? 50 points, not in percentage. I'm talking about points. So you will divide this 1,000 rupees with this 50 and answer whatever comes, this 20. So you need to buy 20 stocks of this company in that trade and put the stop loss at 50 points, which is actually decided by your technical analysis, not by me. It could be 100 points, then it would be 10 quantity. It could be 200 points, then there would be 5 quantity. If it would be 10 points, then there would be 100 stocks you would be buying for this company. It's simple as that, right? So the formula is risk divided by stop loss. And if you are using dollars, then you will put $200 below. If your stop loss point is like suppose 10, then you would be buying 20 quantity, similar to that. All right. The second formula is with the money. It is same for every market. You can use position size formula, and this is the standard formula you can use anywhere. So you would have to write the funds you have, your trading funds, okay, multiplied with risk percentage. Here we are writing risk percentage. Remember this, we are not putting the money here, the amount of money you want to lose, or depending, not you want to lose, or you might lose in a stop loss. All right, and this would be stop loss percentage. So in the last example, remember this, it was stop loss points. Whatever the scale you are using, it would be points. Whatever the currency you are using, it would be the amount. All right, in this formula, it would be risk percentage divided by stop loss percentage. For this example, let's suppose your stop loss was 4%. Okay, just taking an example, 4%. All right, and what was our fund? So let's suppose you had $10,000. Similarly, you can put 50,000 rupees, whatever you want. Risk, what risk we decided to take? 2%. What is our stop loss percentage? 4%. So we will divide this like this, like this. And in this trade, we will take $5,000 as our position size. So anything happens, even Trump wakes up any day and starts putting tariff on your country. Okay, even if any civil war happens in any country globally, the oil chain is affected, the natural gas supply is affected, or blah blah blah, does not matter. All you have to do, if you have your stop loss fixed, which is at 4%, you just need to put your stop loss order there at 4%, and you need to invest in that trade $5,000, and your risk would automatically be at 2%. That was 200 US dollars you wanted to lose in the beginning. Or if you have 50,000, accordingly the mathematics will change. So the formula is very simple. The trading funds, I'm writing it both down. So if you want to know how much money I must invest, all you have to do is your trading funds. Look, my writing might be not very familiar to you, but this formula will definitely be familiar to you when you start practicing it. In the beginning, it might take your time, but with time, you will be doing it only in fraction of seconds. All you have to do is a mathematics, a small maths of fifth class only. That's it. The fifth standard mathematics will do the job. If you are not, if you have not studied even fifth standard, don't worry. You just need to practice with basic mathematics, which you use in buying and selling things in the market. Okay. And similarly, you can use the formula for quantity, the number of stocks you want to buy. All you have to do is you will have to put the risk divided by stop loss points. And that's it. This is the risk management all you have to use. And when you will know before entering a trade that this is the amount I can lose maximum, you would automatically be safe and secure. So if you want to take the screenshot of this, you can take a screenshot of this. If you want it to be written properly, and if you don't understand anything, you can join my free Telegram channel. There I have written it several times, so many text PDFs I have made for it. I have explained it several times in my Telegram live, in my YouTube live. You can also join all of it. All right, so this was a very simple way to calculate your risk before entering a trade. So you do not have to be worried, you do not have to be the slave of your emotions that my trade is going to hit a stop loss, I might lose this much amount. No, if you have a fixed position size, you can't lose more than that. Remember it, there are a couple of exceptions you need to understand. If you are trading a stock or a coin which has low liquidity, it might skip your stop loss. So do understand stop loss better first before putting it. And second thing you need to understand, I have not added the trading fees, the brokerage, the exchange fees which they charge you. So you will have to add that as well while calculating your positions. Remember this, these two things I have not added, because you might be trading on Delta exchange, you might be trading on CoinDCX exchange, you might be trading on stock market in India, you might be trading in US stocks, you might be trading in Europe somewhere, you might be trading euro or pound, right? You might be trading fiber, cable, anything like that. So remember it. So you will have to add your commission, brokerage, whatever you call it, with this calculation, and you are good to go with this risk management. I hope you like this video, and if you enjoyed it, if you liked it, share it with your friends, share it with your all beginner friends who are actually looking for the risk management and want to start trading or investing. Just give it to them, tell them you can use the same formula for investing as well, that how much you must invest in a single coin or on a single stock or in a single trade idea, and you can figure it out very simply with a simple mathematics. I hope you loved it. So don't forget to share it with your friends. Take care of your family and yourself. I'll see you in the next video. Take care. Bye bye.